TipRanks presents TIpTalks, the only podcast where you can listen to the insights, discover the trends, and power up your investment portfolio.
Now, speaking of some of those investments, I just looked at actually your profile on TipRanks, and I did see that on September 15th, we had a rating from you of a hold on Brown & Brown. And I'd love to understand your outlook on Brown & Brown. For those of you who don't know, of course, Brown & Brown is an insurance agency, so it's right in Meyer's niche. And now that we have him live here, I'd love to get his take on that recent rating and what we could expect for Brown & Brown specifically over the next, say, 6 to 12 months.
Okay, so let's talk about Brown & Brown. And this is perfect. I was actually at their headquarters last Thursday. They had an investor day. So
there we go.
I am fresh from Daytona Beach. Brown & Brown is a phenomenally well-run company. And by that, I mean really two things that people care about for insurance brokers. How fast can you grow? Same-store sales, we call it organic or internal growth. And how much profit do you make on every dollar of commission or fees that you earn, every dollar of revenue? And they have been leaders in both for a long, long time. And that's a function of an intentionally decentralized strategy. Basically, they either establish or buy offices. We used to say just around the United States, now the United States, Canada, the UK, Western Europe. So they are expanding internationally, looking for people with the same mindset. Now, the good news is they're all very good at this sort of thing. The less good news, and the reason why we would have it at what we call market perform, our equivalent of a hold, are two factors. First, I agree with what you're saying about the Goldilocks scenario. We have been anticipating a recession all year. Hopefully this is true. It doesn't look like it's in the cards. But the tailwind, if you will, of inflation, which actually helps generate revenues for insurance brokers, that seems to be fading, right? Insurance is basically, what does it cost to insure and how much are you insuring? That second part is expressed in nominal terms. So if inflation is higher, you'll get more premiums and therefore more commissions. If the inflation rate is fading, then you get a little bit less of that. So one of the tailwinds that's really good for insurance brokers, I think will be later next year than it was this year. And by the same token, or by the same approach, the rate of insurance rate increases is also likely to slow down. We are seeing the same discipline that we mentioned earlier on reinsurance. We're seeing that in insurance lines as well. The industry is behaving responsibly. And for those of us that have been covering insurance for a long time, that's a market change. We used to not see that level of discipline sustained for a long period of time. But now we are. Now, that's great in terms of profitability, for sure. But what it does mean from a simplistic investment standpoint is that we no longer need dramatic rate increases because insurance pricing is getting to be okay. Now, claim cost inflation is high, so rates will keep rising, but they'll be rising by less. And if the amount of stuff to be insured isn't growing as fast, and if the rate of insurance rate increases isn't as strong, then the two tailwinds to revenues are going to fade. That's not a reflection of Brown & Brown. The only manifestation of that is that it's their job to help their clients limit their insurance spend, which is a good thing to do, but also mitigates the tailwind. Because of that, we're a little bit less optimistic on how insurance brokers will do compared to other subsegments of the insurance industry. So that's where Brown & Brown fits into that.
Okay, now I got to throw this one your way. So that's Brown & Brown. And It wasn't too long ago, right? It was back in August 17th, where we also show an Allstate rating, but yet Allstate here was a buy. And now I got to ask you, because if Brown & Brown's a hold based on this current environment, how in the world is Allstate then a buy?
So it's a great question. Allstate is first and foremost a personalized insurer. Its single biggest product is car insurance. And we look at Allstate as really a good example of a company that has been struggling with very poor underwriting profitability, actual underwriting losses in the auto space, because the rates that it's charging were not keeping up with claim cost inflation. We think the third quarter of 2023 is when they finally cross over, and their auto underwriting margin, really the statistic is the loss ratio, should be better this year than last year, overwhelmingly because of the cumulative impact of rate increases. We're also seeing, and this is a much smaller factor, the price of used cars is now down on a year-over-year basis, and gasoline is more expensive, so people are probably going to drive a little less. So there are some external factors that maybe contribute 10% of the overall momentum to developing a better pricing scheme. But that's what's going on with Allstate. It's been sort of a long, I hate to use this metaphor, it's been a bumpy road for the car insurers for a while. But I do think we're finally get to the point where people can take a step back and say, you know what, this has been terrible, but the end is in sight. We should get back to appropriate returns. And the first step is for things to stop getting worse, right? When you're in a hole, the first step is to stop digging. We're seeing that. I think in the third quarter, they should actually have a better result in the car insurance than they did last year. And I think that will lead investors to say, okay, now that we know that this is eventually a manageable problem, we can start to value Allstate on what it's going to earn as an appropriate return on underwriting profitability.
Interesting. It really is. I mean, to think about the analyst perspective, and as an investor, again, always speaking with investors, whether on TipRanks, friends, family, about the market. What I often hear is a lot of investors talking about, right? We have at TipRanks, the TipRanks Smart Score, if you're familiar, which is a scoring system that can literally change on a day-to-day basis. It factors in insider trading, hedge fund activity, macroeconomic environments, what analysts are saying. But there's so much more to, I feel, analyzing a company. And it really sounds like, you have it down pat, especially when it comes to Brown & Brown, Allstate, the alike. But I'm curious to know, how would you recommend for not only our users of TipRanks, but viewers who are out there, how would you recommend all of us to begin to look at companies more like an analyst, right, with the real insights? Because obviously we're not coming to an investor day. We can't unfortunately all make it there. But how can we get as close to the insiders or close to the data as possible to begin to understand the companies as you do as an analyst?
So it's a good question. I think if you're going to be looking at individual stocks, then there's no substitute for the SEC filings, particularly the quarterly and annual filings. And for someone that's going to be investing in individual stocks, I think to do that well, you have to have a time commitment to it. So if you can actually build an earnings model, you can look at the last, let's say for Brown & Brown, you take the last, 50 quarters, but that's a lot of work. Take the last 3 or 4 years and model that out based on the information they provide. How quickly are they growing? How quickly are their margins expanding? And then there's some other stuff. There's taxes, there's interest rates. Those all matter, probably less so. And come up with an individual view of what this company is going to earn. I think that's the bare minimum you need to have if you're going to invest in an individual stock, is the time investment and the confidence to say, this is what they're going to earn, because that will determine the stock price. Now, you'll have the individual views, and sometimes we'll be right and sometimes we'll be wrong, but I would really start with that. Now, that's the quantitative part, because there's plenty of information. There are income statements that you'd want to plug into a spreadsheet, and then make sure you go through the qualitative discussion so they can say, this is what's going on. Brown & Brown will give you their viewpoint of, for example, rate increases. It really matters to them because it impacts their clients so severely. And you'll get that from the qualitative disclosure that they have. And I think that's probably the right first step.
Fantastic and really great insights, especially from an analyst who's doing this on a day in and day out basis. I got 2 more questions for you before we wrap up for this webinar. The first of which is, I want to know, from you specifically, I'll place you back on the hot seat right here at this one.
Absolutely.
But which position or which stock has been out there that, it's been incredibly hard to really analyze, for you just based on the economic environment? And then on the flip side of that script, which stock are you really favoring? Or is there a particular stock out there that you are incredibly bullish on, right now and would share with investors, hey, take a look at this stock. It's one that should certainly be on your watch list to do more due diligence on.
Okay, so let me answer those in order. The most complicated stock, this is not going to be a surprise, Berkshire Hathaway. Warren Buffett is great at a lot of things, but I would suggest politely, he's not great at disclosure. And what we've seen over time is that what gets broken out changes. We don't really have a retrospective view. So it's hard to build a continuous model in the way that I described, maybe building one for Brown & Brown, because there are different segments. And it's really just complicated to have a time series there. And there's a lot of qualitative discussion of, let's say, how the energy companies are doing, but that's not as substantive for us compared to quantitative numbers. If we had, 5 or 10 years of quarterly data reported in the same format over and over again, I'd be much more confident. And there is also much more exposure to the uncertainty in the macroeconomy, right? We talked about gas prices being up. For car insurance companies and energy companies, that's great news. But for people that pay for gasoline, less so. So what's the impact bleeding into other elements of the Berkshire Hathaway empire? So that would be the one that's the trickiest to analyze. And I think politely suggested in my research that they should add disclosure. So far, I haven't convinced anybody in Omaha.
Well, we're trying to send this video over there.
Absolutely. And let me know who I should call back.
Yeah.
In terms of the best opportunity, I'm going to go with AIG. We talked about them being like an underperformer in years back. Since then, they had one incredible uptick in terms of not just senior management quality, but starting with senior management all the way through the ranks, coming up with a much better strategy and much better people to execute on that strategy. And they've made a tremendous amount of progress on a whole host of levels. What they're doing now, which I think appropriately would have been the 10th and 11th and 12th priorities, because the preceding 1 through 9 have been accomplished, they're splitting into 2 separate companies, property casualty insurance and life insurance, simplifying their operations, eliminating a lot of expenses that will make them much more competitive with their peers, and buying back an enormous amount of stock. So if I had to pick a name, and the good news is it's less complicated than it used to be, it would be AIG as a company that's now, I would argue, a very good underwriter executing on the next round of its priorities.
There you have it from Meyer Shields himself. One last question for you, Meyer.
Mm-hmm.
Now that we're about to close out 2023, how should we be feeling? Should we be feeling bullish, bearish? As an investor right now, I mean, I'm always sharing with our webinar participants and viewers and those I speak with in our customer base to really use TipRanks as the platform where you can prepare for the worst, but always hope for the best, of course, right? And we know over time, the market will be back, the market recovers, there's cycles, but how should we be feeling right now? And how would you recommend we all begin to prepare?
Okay, so this is going to sound like I'm ducking the question, but only because I'm kind of ducking the question. I would say if you're focused on insurance, then you should be bullish, because there are a couple of exceptions. For some reason, public company directors and officers liability insurance is seeing this massive level of competition. And there's a lot of theories in terms of why. No one really knows, but it's really, really contained. Outside of that, insurance is behaving better for longer than we've ever seen in the past. So what I will say is that we have relative rankings within the property casualty space, but overwhelmingly things are moving in the right direction. We spent a lot of time talking about the underwriting side. Insurance companies also focus on investment income. Between when they collect your premiums and they pay it out, they invest those proceeds, mostly in bonds, and interest rates have gone up. So we're seeing an awful lot of positive momentum on underwriting profit and on investment income. So I'm sort of going to be sticking to my tunnel vision knitting here and say that if you focus on the property casualty space, I think there you can legitimately be very bullish. And for better or for worse, insurance is largely independent of broader macro trends. So whether we get this long-awaited, unrequited recession or hopefully we don't, doesn't matter that much to insurance.
Fascinating. And it makes really, rings true, at least the fact that every investor out there should really be sticking to their niche, what they know. And if you don't know a particular business model or an industry, begin to do your due diligence, understand it like an analyst. Now, I want to share once more, we have Meyer Shields on with us from KBW, ranked number 389 at this point in time as of this recording, out of over 8,500 analysts. So truly, Meyer, it's an honor to have had you on with us. We'd like to actually invite you back for another webinar with us because of the insights that you have specific to the insurance industry. And again, I want to thank you for joining us. And investors, until next time, we will see you all there.
Thanks so much, Ari. It was great talking to you.
TipRanks presents TipTalks, the only podcast where you can listen to the insights, discover the trends, and power up your investment portfolio.